Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Tax traps, Eric. We read about that.
Tax bombs going
IRAs, 401ks,
tax,
annuities. You know, the list kind of goes on and on. But
nobody wants to talk about taxes. Death and taxes.
We don't want to pay them. That's for certain.
What it is. Okay, talking about them is okay, but when it comes to annuities, one of the most common things that's kind of not discussed is kind of how they are taxed,
yes,
especially on the deferred annuity side. So
right.
we should start with
last in, first out.
LIFO. Sounds like a dog food commercial.
So the earnings that folks get are, assuming they've got earnings, and annuities do produce interest earnings, those are going to be taxed first. So as you take money out, typically it's going to be taxed. But then there's the basis inside the annuity. The money that folks put into it initially.
Right.
Once it gets down to the basis, it's not taxed.
So you've got your premium, your principal.
Yes.
And so that's not taxed.
Right.
Any earnings you have on top of that, interest crediting, that's what's taxed. And usually that's the last piece that's added in. So when you start taking withdrawals,
yes,
you're getting taxed on the interest credits right off the bat.
Right, the earnings. And then a lot of folks get it confused too. And they think that, if it's an IRA or a 401k,
nothing's been taxed.
Right, exactly. So it's all going to be taxed. And so it wouldn't really matter if it was in an annuity.
Right, and so I should have clarified my statement. That premium that you put in, that's if it's already been taxed premium.
Yes.
Yes, if it's never been taxed, yes, you're going to get taxed on the whole kit and caboodle.
Correct. And one of the things that we've used quite a bit and help people to understand, and this is only with an immediate annuity, is the exclusion ratio.
Right, and the exclusion ratio basically says that each payment is a return of both principal and interest to you. So they're excluding the principal portion, and they're just taxing you on the interest. So thus the exclusion ratio is the percentage excluded from taxation.
Exactly, and again, if IRA, 401k,
Boom, sorry,
you're going to pay it all.
You're going to pay it all.
I know we've had folks that are like, well, I want the exclusion ratio. Well, it was an IRA, and
we'd all love the exclusion ratio on all our money.
That just simply means when it's the IRA that it's never been taxed, so the IRS is going to get their tax one way or another, as a rule.
Yeah, and we should say, I think we're not trying to avoid paying taxes here. Well, we're trying to avoid paying more taxes than we need to.
Yes.
And there's all sorts of ways to use annuities in different structures.
Right.
To reduce taxation, reduce planning, and you can use that through advanced planning techniques.
Yes.
Or even conversion. So, I mean, the most common way to avoid paying tax, in the future, is to pay the tax now through a Roth conversion or something of that nature.
Roth conversions work very good for that. Also, rolling out into life insurance, but again, that means that you have to actually pay the tax first. So that's another way that we look at getting income that's tax-free, is to use Roth money. And that can continue to pay income throughout your life, with no taxes, which is hard to beat.
Yeah, I'm all for the no tax version. So,
and then as you're taking on those accounts where you do have to pay the tax, because it's you're either taking earnings out first, or it's all an IRA. One of the things that we've been very successful with, Eric, is setting these accounts up so that we get the client's money out of it quicker.
And started working on the insurance company's money.
Exactly. And so, everyone understands that, that money that's coming out on that monthly paycheck or whatever, there's going to be ordinary income tax on it. And so it's just, the key is not having to also pay these big lump sums of tax, by taking too much out.
Well, and we should probably talk about the lump sums of tax, because a lot of misconceptions about moving, especially when you've retired, you've got this big 401k or IRA.
There you go.
I want income now, but boy, I don't want to pay all this tax to get into an annuity.
If I buy an annuity or allocate my money into an annuity, I'm going to have to pay tax on it and then put it in the annuity.
All right, misconception dispelled. You don't have to pay the tax, because what you're going to do is you're going to transfer the dollars in, and it's still going to be an IRA. It's still going to be qualified dollars. It's just going to have an annuity wrapper within it.
Exactly. It's going to go from one custodian to the other. The IRS looks at that as a rollover. and as a result, there's no taxable event.
Right. So you don't have to worry about getting hit with that big tax bill.
Yes.
They'll be able to use qualified dollars in an IRA or in an annuity.
All of the negative articles that I see, we talk about, usually say, well, annuities have no step up in basis, which is true. And what that simply means is that if you have securities and those securities pass over to your heirs, that basis has stepped up to whatever the value was at the time of your death. And in an annuity, in an annuity, there is no step up in basis. Whatever the account value is, that's what passes to the heirs as a taxable portion.
Right.
However, there's so many ways, folks, to structure an annuity for great estate advantages. And one way is the stretch IRA,
right,
which works very well.
Very well.
Yes. Another way is a carve-out, where you actually take the portion, an estate planning carve-out, where you take the portion of the annuity that you really want to go on to the heirs. You carve that out and you use it as a Roth, or there's several advanced techniques that can be used, but we'll get into that maybe at another video.
Yeah, talking about stretch IRAs, if your advisor's not talking to you about named beneficiaries, you're losing out on the ability to really manipulate kind of the taxation aspect of working within the annuity world.
Right. So I think, folks, the key is work with a specialist. Leverage that IRA with all of the different statutes with the IRS that can give you an advantage. So I would say that annuities can be a tax trap if they are used incorrectly, but if they're used correctly, they're not a tax trap.